What's up, everyone? It's Caddy with Money Investing. In this video, we are going to be talking a little bit about some of the reports that have come out over the last couple of days with respect to the overall market. And this has come out from Goldman Sachs, Reuters, Bank of America. We're going to talk a little bit about what they think about interest rate projections when it comes to the Federal Reserve. So are they going to be cutting? Are they going to be raising? What is going to be that end terminal rate? Then we'll talk a little bit about equity flows and what the rolling average has been for net buyers versus net sellers. And we'll also talk a little bit about the equity put call ratio and what is that suggesting about the markets. So all of that is going to be condensed in this video. So hope you guys enjoy it, find it helpful. If you do, don't forget to subscribe to the channel, and also do check out the links down in the description below for our Discord and our Patreon. There is a 16% discount on an annual basis that does expire in 2 days. So after February is over, that will go away and will expire. So links are going to be down below if you're interested in joining us. So first things first, Seema Shah, strategist, pretty much mentioned that the strong labor market fueling inflation means that the previously predicted third quarter recession is going to be pushed back or delayed until later in the year. And she also said that investors should not expect a cut in interest rates until 2024, thanks to a strong U.S. economy and the potential for a delayed recession. I think that's exactly what the market's also pricing in. Last time I checked, the market was not pricing in any more cuts for 2023, and it's now very much in sync with what the Federal Reserve has also been telling us. And now we're expecting at least about 75 basis point hikes remainder of this year, and then keeping rates at a higher level at well above 5% for the remainder of 2023. She goes on by further saying that, in fact, the Federal Reserve is keeping interest rates higher for longer in the scenario that we're looking at, and you're looking at tighter policy, which does unfortunately mean that for the market is a little bit more concerning. Now, when it comes to cuts, they mentioned that there will be absolutely no cuts this year in 2023. When asked when investors should expect a cut in interest rates, Shah responded that it wouldn't be until 2024. And it comes that its economists appear torn on when the Fed will start to reduce rates and by how much. Goldman Sachs expects interest rates to hit 5.38% as a terminal rate, and for the first cut to come in in the first 3 months of next year, so in the first quarter of 2024, and for us to drop from 5.38% down to 5.13%. Economists polled by Reuters, however, expect the U.S. central banks to cut rates in the fourth quarter of this year and in the range of 4.75 to 5% after hitting a peak of over 5 to 5.25% in the third quarter. So a little bit of a discrepancy there, a little bit of a difference of opinion. Shah explained that the tracking inflation numbers now and comparing them back from the 1970s cycle showed that a very close correlation is existing, and if rates were to get cut too early, that could mean that inflation could once again spiral out of control and start reaccelerating and increase, right? So once again, draw back to Federal Reserve Chairman Jerome Powell's speech and how he has talked about premature loosening policy. That's exactly what they don't want to do. And in the 1970s, of course, we saw double-digit inflation numbers, and for those reasons, the U.S. Central Bank was forced to increase interest rates up to as much as 20%. We had William Miller, we had Arthur Burns, and then those were followed by Paul Volcker, of course. But in the mid-70s, the rates were lowered, and inflation did spiral out of control. Once again, it did start accelerating more strongly later in that decade, at which point Paul Volcker was appointed as the chairman of the Fed. The one big takeaway is that the Federal Reserve, they clearly have a lot more work to do. And Shah said that we are expecting further rate hikes, absolutely no cuts this year. Now, how does all this impact the stock market? Obviously not too very well. So Shah implied that the market has not yet fully priced in the cost of rates staying up this year. She pointed towards a surge in bond yields over the past 2 weeks. So we have seen the 10-year, the 2-year, the 20-year, the 30-year, all the bond yields have been pushing higher. And there's been a counter trend rally in the bond market. And she says that this is an indicator of the pressure that is building up for a repricing in the market. And I think the market has gone too far, referring to the 9% gain in the S&P 500 since September. And we have seen a number of investors saying, look at the economy, it's so strong. How can we possibly be negative at this stage? And Shah is saying that the Fed is going to keep going. They're going to keep tightening, and that means the pressure will continue for the market. So the bottom line is that it all comes down to obviously inflation, right? Inflation is going to be the big data dependent, big data driven, big leading indicator, whatever you want to call it. Inflation is it. So if inflation starts to trend lower, if we see some very significant improvement in inflation over the coming months as shelter prices roll over, it's possible the Federal Reserve changes its tone, changes its policy, changes its direction in the way in the way we move with respect to interest rates, and it's possible that we start to see some probability of cuts and also don't get up as high as what we're expecting right now. But inflation, if that doesn't come down, if you start to get into a stagflation type economy, if it starts to trend sideways and becomes more challenging for the Federal Reserve to bring down and put back in the bottle, then yes, there is a possibility that the market may need to get repriced considering a much higher terminal rate and absolutely no cuts until 2024. Because the one thing the market likes to do is anticipate. It is predict prematurely what the Federal Reserve is going to do instead of waiting for the green light from the man himself. So if the market, again, tries to anticipate different things, if it tries to predict what the Federal Reserve is going to do, and if it comes off on the wrong side of the stick, well, that's just going to lead to more disappointment and more potential selling pressure in the market, something that we have seen already in 2022. Now, I wanted to go over the equity put call ratios. So this right here is the chart that you can already see the 21-day equity only put call ratio. This has been actually a very good indicator for ourselves. I've kind of break that down on our stock charts, but this is pretty much showing us that we are now approaching a level which is considered as a quote sell signal, not necessarily that you want to, completely exit out of your portfolio, but something you want to definitely be paying attention to if you are trading. Not if you're investing. Again, I want to make that distinction. Not if you're investing for the long term in quality companies, but instead if you are trading certain ETFs, if you're trading certain stocks, definitely something you want to pay attention to. For this indicator. So this is the weighted ratio, and it's now at a sell signal according to the computer analysis program. And the sell signal is emanating from a very low level. And from the last two from this level where sell signals were back in April and August of 2022, both were very strong signals when the markets also dropped quite a bit. And meanwhile, the standard ratio has crawled upwards, but the computer analysis programs are not yet, quote, saying that this is a sell signal. This is the latest rise as a question mark on the accompanying chart right now. And quite surprisingly, we are also seeing a lot of ordinary investors bailing out of stock funds for months, according to Fidelity data. So this right here is the chart that pretty much goes over money coming out of stocks and fund flows to the stock market funds. And this is a 3-month moving average. And you can see that since about last spring, April, May of 2022, we have seen consistent outflows from the market, from equity funds and from ETFs. Now, this doesn't necessarily mean that this is a complete bailout from the stock market. It's just from stock funds and ETFs. So chart above shows the money flows into and out of stock mutual funds and ETFs. And when the numbers are positive, they show the public put money into these funds and then they took out, that the public on balance were net investors. If the numbers are negative, they show that they are selling they're selling outweighed the buying, then that public on balance was taking its money out of the stock market. Now, again, I want to make that key difference there, because in that report, they mentioned the stock market, but instead what it's really showing us is stock mutual funds and ETFs. So it is possible that this is only taking into account certain funds, even though it covers 98% of the fund market and funds in general. But I don't think it covers but I don't think it takes into account individual stocks, right? So it is possible that people are more, excited or inspired to be investing in individual stocks as opposed to investing in funds that can definitely charge very high expense ratios in some cases, even as much as 2%, 3% per year. So it is possible that yes, stock funds and ETFs might get a little bit of an outflow, but individual stocks, as we have already seen from other data, retail traders have been putting in more money into individual stocks such as Tesla, Nvidia, Google, AMD, Meta. Like all those companies have seen a lot of inflow to begin with. So the bottom line is that we are, again, in a very, very uncertain environment. Not so much an uncertain environment, but a very questionable environment and economy, because right now we're trading at a range where the S&P 500 can be argued as a little bit of a higher price earnings multiple from an aggregate basis. Earnings have been coming out. They've been coming out decent. Guidance has been okay. But a lot of the effects of higher interest rates are not going to be seen until a few months later. The Federal Reserve is still hiking, and they're going to keep hiking. They're going to keep going after it. And a lot of it depends on where inflation ends up going. So if inflation ends up lower 6 months from now, it is possible the Federal Reserve pivots and starts to pause and eventually cut. But if inflation doesn't come down, then we're definitely in trouble, in a sense that I think the market would need to get repriced and the valuations can drop here considering how much we've already pushed up. So those are some things that we definitely have to consider when we are looking at the markets as a whole. Of course, from an individual stock basis, you have to do the analysis on those companies and figure out for yourself whether these are undervalued, overvalued, fairly valued. Of course, our community is here to help as much as we can. And then you can also look at swing trading, trading options. There's a lot of opportunities to be taking advantage of the volatility that we're seeing in the markets. So I hope you guys enjoyed this video and a quick update. This was a little bit of a daily dose of the bearishness for all the bears out there, because we're definitely in this predicament of what the Federal Reserve is going to do with respect to inflation and interest rates. So that being said, I'm still being very cautious. The futures right now is slightly higher, but we'll see what next week has in store for us after a very brutal week last week, and February so far is a down month for the market. So hope you guys enjoyed this video, found it helpful. If you did, make sure that you drop a like. Don't forget to subscribe to the channel, and the link to our Discord and Patreon is going to be down below if you're interested in joining us. Don't forget 16% annual discount that does expire at the end of this month, and you'll get access to all the private videos and benefits, and of course, not to mention all the channels and alerts, and all that stuff is going to be included. So link's going to be down below. So always happy investing, and I'll see you all in the next video.